My name is Kurt Knoll here the Director of Member Relations here at Barnabas Foundation. And joining me today is Mr. Adam Lopez, one of our senior planners in our planning department here at the foundation. And today's topic is all about gifts that pay income for life. A couple of housekeeping items as we get started here today. The session is being recorded. And if you are interested in sharing the recording with a friend or colleague or neighbor, you can do so by finding it at barnabasfoundation.org and click on the interactive banner at the top of the screen. You will find also there at that website recordings of all of our prior sessions that we've done on various different topics related to estate planning or complex giving. If you have questions throughout today's broadcast, feel free to type them into the Q&A portion there at the bottom of the Zoom screen. And they'll come up on our screen here, and we will go ahead and dive right into those questions as they come through. It's going to be a high-level overview of gifts that pay income for life. Now, as we talk about these various items, whether they be charitable remainder trusts or charitable gifts annuities, there are a bunch of different variations of these, and we could spend literally hours really walking through all the fine details of each and every one of those variations. And that's not the purpose of today. Over the next 20 minutes, we want to give you a high-level overview so that you understand the basics of how these gift agreements work. And if something you hear today triggers an interest in you about wanting to learn more, we would encourage you to go back and contact the representative from the ministry that invited you to today's broadcast, or feel free to contact us directly. Our contact information will be at the bottom of the screen or on the screen at the very end of today's broadcast. Adam, good to see you. Thanks for joining us today. Appreciate you spending a little bit of time of your day with me here and talking with the fine folks who signed up and registered to participate in today's conversation. So first off, let's just start with the question, what is a life income agreement?
Well, thanks for having me. Good to see everybody. A life income agreement is a particular solution that works really well in a situation where you would like to give more, but you're concerned about having enough income for the rest of your life. And so the 40,000-foot view, before we dive down into the weeds, like Kurt said, this is a six-hour promotional event, so I hope you have easy dinner plans. But no, the 40,000-foot view is you, the donor, take cash or other assets and place them into this gift vehicle. The IRS has an arrangement whereby that gift vehicle then pays you an income stream for your life and the life of your spouse. We'll get into some of those other variations later. But then at the end of your life, whatever is remaining in that asset then passes to charities that you have already designated while you were setting up this gift. So it's a real powerful tool that allows you to make a significant impact in charity at a later date while making sure that you have enough income for the remainder of your life.
Excellent. So what, when we talk with donors about these, often people ask, what are the benefits of doing something like this? What are those high-level benefits, Adam?
Yeah, it's really fourfold. So obviously the income stream that you receive is a major benefit. You also receive a charitable tax deduction for a portion of the value of the gift that you gave. And that's a really nice tax benefit to use against your income in the current year or the next 5 years if you can't use it all. If you give an appreciated asset, the third benefit would be either the deferral or sometimes the complete avoidance of paying capital gains tax when you gift an appreciated asset. And then the fourth benefit that I would mention is that you take an asset that you either no longer need or maybe an asset that has become difficult to manage, and you're able to repurpose that into an income stream for yourself, and then as a huge benefit or a blessing to Kingdom Ministry upon your passing.
You mentioned one of the benefits being a partial tax deduction. Can you just share why it's not, normally if you make a gift, you get a full deduction. So what's the difference there? Why do you not get a full deduction?
Yep, great question. So if you give, let's say you give a rental unit to charity, and you give that unit completely to charity, you have severed all legal ties with it. You have no incidental benefits. There's no rights you retain. That is now solely the charity's property. In those situations, the IRS says you are able to get a fair market value tax deduction. However, with a life income gift, you are not completely severing that ownership. You're retaining a right to a stream of income. And so the IRS has a series of tables, and I see we just launched the graphic here. The IRS is a series of tables that determine what is the value of that income stream, the benefit that you retain, and then based on that value, what is your charitable tax deduction? So your deduction is always going to be a portion of the value of what you gift through a life income gift, never the fair market value. But still a powerful tool because you're getting that income stream plus the deduction.
Right, right. Well, and the other thing you mentioned was that elimination of the hassle factor, right, of ownership, especially as people move into their later years of life. If you're still owning those rental properties or other assets that are just require some level of ongoing maintenance or work on your part, all of a sudden it becomes a rather substantial hassle. And this is one way in which to eliminate that hassle, as you mentioned, as well as get the deduction and retain that income stream. So, and avoid the tax. I mean, there's so many wins here. It's amazing. So, we've been doing this for quite a long time. We've seen a lot of assets get gifted into life income agreements. What kind of assets in your career here, Adam, that you've worked with that people are making as gifts into a gift annuity or shared remainder trust?
Well, I'd say there's a top three, but there's a wide variety of what we see. The top three would be cash. The second would be appreciated publicly traded stock. And the third of the top three would be appreciated real estate. Those make for easier gifts. As you can imagine, anytime the IRS gives you a benefit, they have a number of rules they want you to abide by. And so these type of gifts are the more straightforward types of gifts. You can also have things like LLC membership interests, partnership interests, business equipment. I cover a lot of states with farmers. So I've done a number of charitable or life income agreements funded by combines or manure spreaders. Same thing with commodities. You can put commodities in there or other business equipment if you're not in the business of farming, but you're, in construction. There's value in using fully depreciated business equipment to fund these types of gifts. So it's really all over the board, but the top three we do a lot in those specifically.
Right, right. So I kind of touched on a little bit that there's two real common types of these things: charitable gift annuities and charitable remainder trusts. And so let's dive into those specifically and talk about each one of them. And starting with the CGA, can you provide an overview of how a CGA or charitable gift annuity, what it is and how it works?
Absolutely. So CGA is very much like a commercial annuity, except in this case, you are giving a gift to charity. In return, they issue you the annuity. So you receive that income stream for your life and for the life of your spouse. A couple of interesting things to note about that income stream. Number one, it's a contractual right. So when you do an annuity, let's say you put $100,000 into this annuity, you get your payout rate. But if the investments in the annuity don't perform well and they go down, your annuity payment does not change. If the annuity completely zeroes out of money, the holding charity is still responsible for paying you that annuity amount. And so this can be a great tool for people who are looking to secure consistent income. And that is because it is an annuity is a contract. So as long as the holding charity has sufficient funds, even if in the annuity itself, not as much money remains, they're still responsible for paying you the same amount. The payout rate itself is a little bit unique in that the payout rate is solely determined by your age. The IRS has a series of actuarial tables, and they review those every year to determine, okay, based on your age and your life expectancy, what rate can you expect to receive? So right now, just by way of example, an individual who's 55 years old would receive a 4.8% annuity payout rate, meaning if you gifted $100,000 into an annuity, you would receive $4,800 a year from that annuity for the remainder of your life. The older you are, the better the payout rate. And so we often see people of more advanced age utilizing these because they get a higher payout rate. 4.8% might not be the best, rate. There's other investments, income producing investments out there that can exceed that. So for example, at 65 right now, you could get a 6.7 or a 5.7% rate. You jump another 10 years up to 75, you get a 7%. and up to 85 a 9.1. So you can see there's a dramatic increase. The older you are, the higher the payout rate. So you receive that income stream for life. You also get a tax deduction, again, for the portion of the value of the gift. And if there is any capital gain associated with the gift, the payout is taxed in a certain manner. There's ordinary income taxation followed by capital gains. And then the really big nice benefit is part of your each payment during your life expectancy is tax-free return of principal. And so there is a way, utilizing a different number, I don't want to go into it too much, but you can increase the amount of tax-free return of principal in each payment, or increase the amount of your charitable deduction based on this internal interest rate that you can select with this gift. So people really like with the income stream, the tax deduction, the deferral of capital gains, because in the tax world, we say tax deferred is tax saved, including the tax-free return of principal. The charitable gift annuity is a pretty powerful tool.
Mm-hmm. What do people typically use to fund a charitable gift annuity? What are the most common types of assets that go into them?
Typically cash and appreciated stock, publicly traded.
Okay.
Every once in a while, we'll get requests for property to be used. There's some additional concerns there, but they can be used for that matter, but we take it on a case-by-case basis to make sure that it's going to work properly. But I would say for the most part, it is cash or publicly traded stock.
Yeah. And just to clarify one thing, you noted the IRS sets the rates. It's actually an organization called the ACGA, just so I saw a note. We follow the American Council on Gift Annuities suggested rate tables, which is a group of charities and actuaries that kind of set those rates. And just for a broad understanding, when rates are set and gift annuities are created, there is an anticipated residual to charity of roughly 50% of the original gift amount. And so a $20,000 charitable gift annuity is expected to yield a $10,000 gift to charity at the end of the beneficiary's life expectancy or at the end of their life. And that's kind of where that whole return of principal comes into play, because you're getting part of what you gave back, which really, I mean, it's a great way to generate some consistent payment income, but also minimize some of your ordinary income tax expense. Now let's consider the CRT, or the Charitable Remainder Trust. Can you, again, do an overview of the CRT? What is it and how it works?
Sure. So there are similarities and differences between the two, but the basic similarities are that you take cash or other assets and you place them into this Charitable Remainder Trust, which is its own legal entity recognized by the law, and it's a charitable vehicle. The assets, if it's non-cash asset, it is then liquidated in the trust, and when that trust liquidates it, that sale, there's no tax incurred because, again, it's a charitable vehicle. That money is then invested, and the income it produces is what pays out the income stream back to the donor. At the end of the donor's life, or term of years, this is one of the differences. You can have a term of years trust, not a lifetime one. At the end of life or term, whatever's left in the trust then passes to those charities that you have designated. One of the big differences is regarding the payout rate. So with the charitable tax or charitable gift annuity, your payout rate is determined by your age. Here, with a charitable remainder trust, the IRS says you have a range in which you, the donor, get to select your payout rate, subject to certain rules. But the range is, it must be at least 5% of the initial funding value, and on the high end, it's 50%. So somewhere within that range, you can select the payout rate of your charitable remainder trust. Now, the thought process behind why you would select lower or higher really goes into what your goals are. If you want the trust to remain in place for the rest of your lifetime and your spouse's lifetime, it's probably optimal to select the 5, 6, 7%, more on the low end of the trust. There are situations where people do shorter term trusts and suck out more income in a short time span, and so they may select higher ones at that point. But I'd say the vast majority of people, they're looking to secure long-term income, and so they often select on that lower end to ensure as the trust performs, it's slightly outperforming what the payout rate of the trust is.
Mm-hmm. Excellent. And just a reminder to those who are participating today, if you do have a question about these topics as we're going along, feel free to put them in the Q&A portion on the bottom control panel of your Zoom, and it'll come up here on our screen, and we'll go ahead and take those questions as we go along. But, just to review, Adam, to make sure that I've got this right, under a charitable gift annuity, it's a contractual agreement between the donor and the charity to make this payment for their lifetime. So the payment is a fixed amount at fixed intervals set at the time the contract is put forth. They get a 1099 for tax treatment, so it's primarily ordinary income coming back to them unless it was funded with an appreciated asset, and then there's going to be a little ordinary income and a little capital gain income. And these are often funded with cash and or stock. And as you alluded to, rates are kind of set. We follow a rate table that's kind of set, and it changes from time to time, but once it's set in the contract. It can't be changed. There's assumption of a residual gift of roughly half of the value of the annuity at the end of its life. Now, that being said, I will mention that people can accelerate the gift to charity by reassigning their income interest back to the charity that issued the annuity, thereby essentially ending the contract and accelerating the gift. So if any of you are holding gift annuities today and you're saying to ourselves, we no longer really need this income stream and we'd like to benefit the charities we wanted to support, you can always go through that release action, which would accelerate the gift out to charity. And then likewise on the CRT, that's a little bit different, right? It's a variable payment typically. The CRT is its own little entity that's typically funded with higher value assets, right? Typical CGAs we see are issued around $25,000 to $50,000 in size, whereas CRTs are over $100,000 and larger. They get to pick the payout rate, but the payout's going to take on the earnings nature of the trust. And so as the trust is earning income, that payout you're getting back every year will take on whatever the trust is earning internally, which may be some short-term. It'll be ordinary income as well as short-term and long-term capital gains. So unfortunately for these, you do get a K1. So it takes a little longer to file your tax returns, a little more complicated. But these tend to be funded with higher valued assets like real estate, business interests, or even highly concentrated stock positions. The one other nuance that I recall is that with CRTs, you can add to CRTs over time. So if you funded it this year, you could, in 5 years from now, you wanted to increase the amount of money in your CRT, you can always add to it. Can't really do that with a CGA, but you can still also release a CRT and accelerate that gift to charity. So did I have all that summary of those details correct, Adam, or did I miss anything along the way?
No, that was well done. You are to be congratulated. So one thing I wanted to note on the CRT with the capital gains treatment, it is a little different from the charitable gift annuity in that if the assets inside the trust are producing ordinary income and the trust is earning more than the payout rate, you are going to pay ordinary income tax 100% on that payment, meaning that the capital gains tax is just sitting inside the trust and you're not paying that. So you may pay a little bit of it, you may pay none of it. It just depends on the performance of the trust. And so sometimes you can get away with paying almost none of the capital gains tax inside that charitable remainder trust. And so there's some avoidance potential there. One of the benefits you mentioned was being able to add to a charitable remainder trust. There's specific types you can add to a charitable remainder unit trust. That's the one you can add to, not a charitable remainder annuity trust. Now, I don't go too far into the weeds on that, but essentially the value of a unit trust is that each year the trust is revalued on January 1. So if the investments of the trust have gone up that year, your 5% payment is going to be worth more that next year because the trust principal is higher. Likewise, in years where it goes down, your payment will be a little less, but this way the trust is flexible with the market. The annuity rate, the annuity trust is you get 5% of the initial value of the trust always, every year, regardless of the performance of the trust. And there are reasons why one is better than the other, but those are useful tools. One comes to mind, there was a business owner that we assisted. He was retiring and he wanted a deduction in the year he cashed out of his business, but then he wanted some income for just a few years after retirement to sort of settle into retirement. And so he did a charitable remainder annuity trust for 9 years at a payout rate of 12%. And so with the trust performance, he withdrew the money he wanted to during those 9 years, and then he got to see the money go to charity after the fact. So
Yeah.
there's a lot of variation that we can play with these tools. It
Yeah.
doesn't just have to be lifetime.
Excellent. And that's where the as you mentioned, the variation allows us to work with you in planning and helping you figure out what's the best solution for your specific need. And Adam, we've had a couple questions come in, and so the first question is, if you have a second home and you decide to put that into a CRT, will you have to pay capital gains taxes on that property that is greatly appreciated?
So the answer is, classic lawyer, it depends. So if you want to get real technical, when you set up the charitable remainder trust, when it goes into the trust, the home, the trust sells it, there's no tax at that point. The trust then invests those funds, and depending on the selection of what you invest in, you may invest in all capital gains producing assets, meaning you will pay capital gains tax, but that's probably all you will pay out of the trust. Some people want to go for more growth, and so they'll be in a blended mix of ordinary income producing investments, capital gain investments. And so as long as if that's what's happening, if the amount of ordinary income produced in the trust is greater than the payout rate to the income beneficiary, that capital gains tax will stay in the trust, and it won't come out. But if, so let's say trust earns 6% ordinary income and the payout rate's 5%, you're not going to pay any capital gains. You're just going to pay ordinary income. But if the trust performed at 4% and the payout rate's 5%, 4% of your payment's going to be ordinary income, and 1% of that year's payment will be capital gains tax from the sale.
Yeah.
So, but it's still a tax win.
Right, but the just to clarify, the original capital gains tax that was due on that second home vanishes when the trust sells it, or right, because the value of that asset goes in at the market value. It's really the investments thereafter that are generating the capital gains that may determine whether or not they have cap gains tax and or ordinary income tax.
Yeah, it's not a taxable event when the home is sold by the trust.
Right, right. So, and this has been a great tool. We had a couple do this with some rental property a number of years ago that had a hassle factor. They were older, they were starting to move into assisted living, they were still dealing with tenant issues, and they didn't want to pay that capital gains tax. And so by gifting a portion of that rental property, and that's a key thing too to understand, is you don't have to gift 100% of the property. You can give a partial interest into the trust. They were able to offset the taxes on the balance they kept. They retained an income stream, but they eliminated that hassle factor and they eliminated that hidden tax that was sitting there on that capital gains. And so over the remainder of their life, which worked very well for them over the handful of years after which that they lived, they had an enhanced income stream and they didn't have the hassle of ownership of this property anymore. And so it was very, very powerful tool. And at the end of both their lives, they both since passed away, they were able to generate a very wonderful gift to the ministries that they loved and supported. A couple more questions, and I appreciate it. Keep coming with the questions. Anybody who has one, instead of a fixed amount, is it possible to have a payout amount that increases to match inflation or some other percentage? You want to go ahead and tackle that, Adam?
Yeah, so once you select your rate, that is your rate. There are variations of trusts in which they have, they call them step trusts or shark fin, where there are increased payments. But those are on the riskier side because the IRS has neither approved nor disapproved of some of these tools. And so it really comes down to your risk tolerance of how much do you want to press and challenge the IRS. So the black letter law says if I select a 6% payout rate for my life, I will receive 6% every year from that trust. But if you have specific example you want to talk through, be happy to set up a meeting with you and talk specifically. We have a wonderful tax program called Crescendo where we can create illustrations based on your fact pattern to sort of give you a visual of how these gifts can work. And those are very helpful when making those decisions.
Yeah.
That's
and you alluded to this. Yeah, you alluded to this a little bit earlier, and we have already talked about the fact that the CGA is fixed for the life of the contract. That we know it's not going to change. But under that charitable remainder unit trust, there is fluctuations in that payment based on the performance of the trust. However, it goes up or down depending on how the trust performs. And so in down market years, the following year payment would be lower than the current year payment. So I hope that answers your question. If you have any other questions, always feel free to reach out to us on this. A question from Ron: with a CRT, what if you want part of the benefit going to a charity and part of it going to an heir? Is that normal? Are there proportional limits? And so I'm assuming the question here is alluding to, at the end of the life, can you have a trust, like a charitable remainder trust, pay out to a charity and then to an heir?
So if this is why they call it a charitable remainder, is that at the end of your life, the deal with the IRS is that you get the income stream, but upon your death, the assets are going to pass to charitable entities only. So if you set one up during life, you cannot benefit your heirs out of your personal estate with those assets. Those are gone out of your estate for estate tax purposes, but you're getting that income stream plus the tax benefits. But then at the end of your life, those are out of the estate and your kids can't partake in those. There is a variation, there's always a variation, but something called testamentary charitable remainder trusts utilizing IRA or retirement assets. And those are set up and funded after death. Those can be used to give to your spouse, or your kids can be the income beneficiaries. But then at the end of the term, it goes back to charity. But that is a rising tool, and it's rising in popularity, people utilizing that. If you have questions, call us about that. We'd be happy to talk to you how those work.
So, but that question did allude to one other form of trust that we don't talk about very often, but it's pretty specific to unique circumstances. So that's a charitable lead trust. Can you compare and contrast that very quickly against this a remainder trust versus the lead trust?
Yeah, can we throw up the graphic one more time? I think it'll be helpful for this quick description. So charitable lead trusts, they essentially reverse the order of how these work. So with a charitable remainder trust, you, the donor, fund the trust, and you are the income beneficiary of the trust. And when you die or the term of years ends, what remains goes to charity. What you're going to want to do is swap the boxes where it says ministry and charitable gift. So you, the donor, would give a gift into the middle box, which is the trust, but it is going to pay out the payout rate to charity. And then depending on the type of lead trust you select, once that term of years or lifetime ends, the remainder that's in the trust either reverts back to you, the donor, if it's a term of years, or if it's life, it would pass on to your heirs at law. So there's two specific types: grantor lead trusts and non-grantor lead trusts. Non-grantor lead trusts are really a play at reducing your estate if you're near the limits for estate taxes. So you can take assets off of your books, put it into this trust. It pays the income to charity for a number of years. And then after the term of the trust, it moves on to your beneficiaries and it's out of your estate. But you have no control over the assets in the trust. That's why it's called non-grantor. The grantor trust is really an income tax tool, where if you have a high income year, let's say you sell your business, you don't want to pay all that tax, you could, let's say your income is peaked, you could cut the top off of your income, place that in the charitable lead trust. That pays to charity for a number of years, and then the assets revert back to you. And during this time, the trust is generating some pretty significant tax benefits for you. There is a big difference. Lead trusts are taxable trusts. They're not like charitable remainder trusts. They owe tax. But it's sort of a charitable remainder trust flipped on its head, but they can be very useful in specific situations, often liquidation of major assets, retirement events, or if your estate is large enough that you're bumping up against those estate tax limitations. The non-grantor lead trust can be very helpful in those situations.
Excellent.
So come talk to us about those because they are more complex.
They are, and that really gets into some really advanced planning techniques that we can use and help you figure out, is it the right circumstance for your particular situation. A couple of final questions here, and then we'll wrap things up. What annuity company do we use? We don't use any annuity company. When a charitable gift annuity is issued, it's often issued by the sponsoring charity, and it's backed by the assets of that charity. Our active gift annuity pool is about 600 active contracts right now. And it's backed by the entire asset base of Barnabas Foundation to fulfill those obligations. And so if you are considering a charitable gift annuity, you really want to make sure you understand the financial nature of the organization in which it's sponsoring or issuing that a gift annuity to you, and do they have the financial wherewithal to fulfill the obligations that they're committing themselves to, with anticipation that there'd be that charitable gift at the end. Every gift annuity that we issue ultimately is paid out to those final beneficiary charities. We do not retain an interest in those. While we technically under the law are the beneficiary of them because we're the issuing charity, we work with you to keep a distribution plan on file. So if there is residual value at the end of your life, those dollars will be distributed to your favorite charities after the contract is fully liquidated from the investment program that we have. There is a question here on a payout rate for age 60. Adam, do you have that table real quickly? You could look that up, and if not, we can get back to you at a later time. Generally speaking, I will say we don't issue immediate pay annuities for anyone under the age of 65. We will issue deferred annuities for people 55 and older, but we don't typically have payments begin until you reach the age of 65 years of age. And that's just a risk management program that we have, given longevity and so on and so forth.
Right now, I'm seeing a 5.2
Right.
for an individual at 60 years old.
Yeah. So that would be for an immediate pay, but it would be a little higher than that because we would work with you to defer that immediate payment until it begins at the age of 65. And then the last question here that came in, Adam, is if they gift a vacation home and do a CRT, can they retain the right to continue to use it throughout the year? And if so, who pays for the property taxes and maintenance and such?
They cannot retain the right. When you embark in one of these gift vehicles, the IRS says you must sever all ties of ownership and beneficial use of whatever asset you place in there.
Mhm.
So if you would like to still go up to the house on the lake, the house on the lake might not be the right tool for a CRT. Maybe a different, a rental property or vacant land or something like that. But yeah, if you're looking to retain use, then this is not the right gift vehicle for you.
Excellent. Thank you, everyone, for your questions. Thank you, Adam, for your time today in providing your expertise. We would encourage you that if you do have questions in today's broadcast, and I see that Kenneth, you do have you have your hand raised. We don't have the system set up where we can turn your mic on. So if you have a question, feel free to just kind of reach out to us at the email address and phone number that you will see here on the screen in just a moment. A recording will be available and posted on our website next week. As I mentioned, all of our prior recordings on various different plan giving topics related to estate planning and other gift vehicles are available at barnabasfoundation.org. And you click on the interactive button at the top of the screen. And this recording will be there as well. And those are shareable. You can share those with your friends or family members. Again, if you have questions about anything that you heard in today's broadcast, feel free to reach out to the ministry that invited you, or reach out to us directly, and you'll see our phone number here in just a minute. Our next broadcast is going to be August 21st, where I will be having a conversation with Lindsay Cannon about the hidden mistakes in your estate plan. And so this will be a very lively topic that I'm sure that we will be covering, and we look forward to seeing many of you then at that opportunity. Thank you again for joining us today. Appreciate it. Adam, thank you for your expertise, and we look forward to seeing you next time. Bye-bye.